Hello friends, this is Professor Amarjeet Kaur. I am Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. This is my privilege that I am here with you to talk about innovative debt instrument. This is the seventh session, seventh part. I am going to talk, again in this regard. So far we have talked about couple of instruments which are innovative debt instruments like zero interest bonds, deep discount bonds, secured premium notes, floating rate bonds, callable or puttable debentures. Like that we have discussed about market linked debentures as well in the past. We also have discussed about green bonds, NCDs with warrants, and we have also discussed about payable when able structures, bonds. So this is what we have discussed, and in the past session, that was part 6, we talked about a bit about innovative perpetual debt instrument, IPDs. So innovative perpetual debt instrument, we just introduced about them. So today in this half, initially I am going to talk about innovative perpetual debt instruments, followed by we will be discussing about asset backed securities, the last part of the innovative debt instruments. So we started talking about innovative perpetual debt instrument in part number 6, and today I am going to talk about that what are the regulations of IPDs, innovative perpetual debt instruments, how are they governed, what are certain more peculiar kind of rules and regulation about them. So friends, SBI and RBI guidelines are very much there regarding IPDs. So the issuance of these instruments is governed by guidelines from regulatory bodies like the Securities and Exchange Board of India as well as the RBI. Electronic book provider platform is required. SBI mandates the issuance of these instruments to be done on an electronic book provider, EBP. So let me explain. So we all know that most of the countries, they would have some or the other governing body. In India we have SEBI, Securities Exchange Board of India, which overall protects the interest of investors, especially in stock market and otherwise too. And then we have RBI, Reserve Bank of India, which is the central bank of the country. So if any bank, so we discussed in the previous part, if any bank introduces or wants to launch innovative perpetual debt instruments, IPDs, they need to seek approval. They cannot introduce or they cannot launch or offer IPDs without seeking approval, right? So the issuance of these instruments is governed by the guidelines from the regulatory bodies by like SEBI and RBI, and thereby we need to seek approval. Not only that, the SEBI, it mandates to safeguard the interest of investor. It really mandates that these IPDs can be issued only through an EBP, the electronic book provider platform, because we have so many platforms to offer shares, we have stock exchanges, we have so many more platforms, but especially for IPD instruments, we need to offer them through electronic book provider platform, so that investor is well aware about the pricing, about the options they are available, in this regard. Further, inclusion in securities, the SEBI has included these instruments in the definition of securities under specific SEBI circulars. So, when we say securities means the financial securities, right? So, we are talking about the financial instruments, and this is the security. So, SEBI has included this as a this is the security, and then coming to risk factor, there are risks like credit risk, liquidity risk, the very much same as any other instrument would have. They are faced by the investor, and the risk of interest payment being skipped. So that has been skipped. So these are the risk factors, primarily the credit risk, the liquidity risk, they are very much there in IPDs as well. Now, after all the discussion we have in the previous part in this regard, and just few minutes ago I introduced again. So, if I have to summarize this IPDs, the first thing is they are having perpetual maturity, because banks are issuing IPDs to raise tier 1 capital, right. So, the bank, because this is the option only exercised by banks, they want to fulfill the requirement of the tier 1 capital which has been raised by or which has been implied by RBI, and banks they raise the capital requirement of tier 1 type capital, not tier 2, only tier 1, through this particular type of instrument known as IPDs, and the maturity is perpetual, reason being, and if it is not perpetual, that they cannot be redeemed at least 10 years in advance, that too after seeking approval from the governing these regulatory bodies. And then the payment of interest is even discretionary, the banks may pay not pay, and we also discussed that the IPDs, they have seniorities over equity, but not over the other creditors. They have the preference, when I say seniority means they are superior to equity in the time of liquidation of a bank, at the time of closing of a bank. So, they always have seniority. So, this is a relatively higher secured in that sense, and since there is no guarantee of interest payments are discretionary. So, certainly no guarantee of income, and it is a long term commitment because of the perpetuity feature in it. So, the yield is higher, relatively higher. And then the last thing which we I want to summarize is the tax benefit on interest paid will depend who is the investor in that IPDs, because there could be treaty between we may have institutional investors, we may have foreign investors, and there could be treaties between India and other country, from where the investor has come. So, the tax benefit would be payable, liable for interest, or tax benefits are going to be availed by certain investors, or may not be available to another, because it will depend who is earning that interest, or rather if I take it other way, bank is paying of course interest, of course discretionary whenever it is paying, but to whom it is being paid, right. So, these are the few features of, or some summary of the feature of the perpetual debt instrument which we have discussed so far. Now, I want to talk about the last innovative instrument, and we will be devoting this part, and even in the next part in future we will be talking about asset backed securities types. Okay, so because it's a very lengthy discussion. So, the last security or the last instrument which is innovative one I am going to talk is asset backed securities, ABS. So, asset backed security, ABS, they refer to financial instrument whose value and payments are backed by a pool of income generating assets such as loans, leases or credit card receivables. The process of creating an ABS is called securitization, which enables lenders to turn liquid asset into marketable securities for investors. So, let me explain this to you. As the name suggests, asset backed security, it means this is a security, this is a financial instrument. This is a security which is backed by some other asset, right. It means the payments or the cash flows from the other assets are supporting payments for this security, right, which we call, it is supported by some, because the functioning of asset backed security is really complex. So, I would want you to pay attention to so name suggests is a simple thing, that something is backing this security, some other asset is backing this security. So, this is by definition we call it as a financial instrument, right. The value of this instrument and even the payment, both, they are backed by a pool of income generating assets which are independent from this instrument, right. So, some other assets which are generating income, You know, for example, we may have loans, we may have credit cards which are generating revenue. So, we may have car loan, we may have some other kind of loan, education loan, etc., etc. We will be discussing types of asset backed security in the future part, in the last part in this series. So, there is a pool of income generating assets which are clubbed together. You know, these assets could be loans, leases, credit card receivable, etc. So, the income which is generated by those assets which is backing this financial instrument, which is we call as ABS, that is used for that is what generates income for this asset as well, right. So, the process of this creating this ABS, we call it as securitization. So because we are combining a pool of assets, be it loans, be it credit cards, we are packaging it as an independent financial instrument called ABS, and then this the whole process of creating this pool together, putting up this asset, all the loans together, all the credit cards receivables together, or lease payments together, etc., etc. It is called securitization. This is a technical term which we use, and this enables the lenders, the people who have extended loan, the lenders, to turn liquid assets into marketable security, because otherwise loans are not assets, right. We understand loans are assets in the books of a banker, of course, but they are not liquid itself, right. They are illiquid. So, illiquid assets, they turn into marketable securities, the securities which can be sold and purchased in the open market. So, imagine a bank X has, or rather I will take example in future. So, bank X has couple of loans in its books, and in the books of banks, loans would be assets, right. It is not the loan. So, they are extending loan. So, those assets are illiquid, they do not have saleable value. Like machinery is also an asset, building is also an asset in the bank's books, but building has saleable value. Whenever banks wants, can sell the building, whenever bank wants, can sell the machinery, right, or anything it owns, but it, or gold for that matter. But here the loans are assets which are not saleable. So, that's why we call them as illiquid asset. So, these illiquid assets are combined together through securitization, and they become marketable securities, and this marketable security is basically ABS. I hope I have done some justice to help you understand this concept of ABS, which is a complex one. The ABS offers diversification opportunities and potentially higher yield compared to any traditional bond, and appealing to income oriented investors. ABS involves many key players including issuers, investors, underwriters, servicers, ensuring the smooth functioning of the market. So, this slide clearly tells you that ABS offers diversification opportunity. Someone can diversify by buying the ABS. For example, in ABS, if the loans were securitized, so there could be thousands of loans, and in, or maybe 10,000 of loans. So, it means there were 10,000 people who have taken loan. Those loans are combined together and put up in a new instrument known ABS. So, what is happening? So, all the 10,000 borrower who have taken the loan, they do not they will not have, in fact, of the equal risk category, right. They all will fall in a different risk category, and if you are buying ABS, you are automatically, your risk is diversified, because that particular ABS has so many loans in it, so many credit card receivables in it. Some credit card would be falling or failing to pay even 1%, another may be for failing hardly a chance of failure. So, we balance out the risk here. So, that's so natural, there's no organic way of diversification happens in ABS. And Of course, because there's a diversification, because there's no liquid asset, there's an illiquid asset behind this. So that is why these ABS are higher yield giving securities, because there's a potential risk, higher risk. There's no real asset which is saleable in the market. This is all illiquid assets. That is why the higher yields are possible. So this type of investment is a very good option of or opportunity of investment for those people who are keen for higher income, right. So because there are people who are looking for high income, there are people who are looking for safety, safety of their investment. So it all depends. We have all kind of investors. People who have good amount of liquidity available, they would buy this because this particular asset or ABS in fact gives you very high yield. Okay. And this ABS is, as I said, is a very complex system. So there are many players. In a normal bond, what happens? There's a company which is issuing normal bond or debenture, and there are debenture holders who buy that. In between, we will have underwriter or trust would be there, but here we have more players. We we have issuer, we have investor, we have underwriters, we are servicers who are providing services. So there are so many people involved in ABS functioning of the market. And the securitization process, which I just said, I referred about, it allows issuers to turn illiquid asset into marketable security, facilitating capital raising and risk management both. And risk associated with ABS include prepayment risk, credit risk, market risk, liquidity risk, which investors have to evaluate carefully. So as I said, ABS functioning is complex. There are so many players in it, and this process of securitization is doing two major things. One, it is facilitating, of course, to raise capital against illiquid assets, and it is also helping the issuers to manage risk, because there are so many loan. For example, if we are issuing ABS against loans, so there are so many people involved who have taken the loan. So there's a high risk. So this is a way of risk management. Somebody is buying them, and that ensures that you will get paid. So there are so many type of risk in ABS, which include prepayment risk. Let's say loan has been taken. Let's say if I have taken a home loan, right, and my home loan terms were that I can pay in advance without any charges. So if I have some liquidity, I would like to pay it off, because I know that I am paying 10% on my housing loan, and I can earn and I am earning as a FD only 7%. So if my investments are in 7% only, then I would like to prepay. But yes, had there been somebody who's able to earn about 14-15% by and by SIP plan or something else, they may not like to prepay. But people like me who believe in safe investments, or in my age, we may prepay the loan, right. So the bank has the risk that the loan may be prepayment. Even that is a risk for them, because to them that is an asset, that is an investment to a banker, right. So then there is a credit risk, of course, that is always there in any security. Market risk is there. The change in market can change the payment conditions and everything. Liquidity risk is always, these are the risks which are very common, and we all know, I understand what they are, right. So this is what investor have to evaluate carefully, because ABS would have all these risks involved. So this is a complex security, complex investment option. So an investor must evaluate very carefully. Then where did they originate it? A financial institution, who is known as originator, issues a large number of loans such as auto loan, credit cards to various borrowers, and these loans are considered asset in the originator balance sheet, as I said earlier, because they generate a stream of income. Because if bank has issued loan, what does it mean? Bank is getting installment every month, including interest in it. A very big amount of the initial installments goes towards the interest payment, and small portion goes towards principal payment, right, repayment in fact. So, financial institutions are the originators, because originally they are the issue, they have issued large number of loans. It could be auto loan, it could be credit card, it could be housing loan or any such thing to various borrowers, right. So, and these loans are in the books of banks. They are the these loans are assets to them, but which are illiquid assets. Which so that's what is known as originators balance sheet, because these banks or other financial institutions are originators. So, this is in their originators balance sheet, they generate a stream of income to them. That is why they are assets. And these underlying assets like loans through assets on the balance sheet of an ABS are often illiquid, not liquid of means, and cannot be sold on their own. So, the pooling assets together and creating a financial instrument out of them, a process called securitization, empowers issuers to make illiquid asset marketable to investors. So, what is happening is that these underlying asset, which is through which securitization has happened. So, the underlying asset has been used because something has been backed, is most of the time is illiquid, as I said, and it cannot be sold on its own. So, the pooling of the asset, right, the pooling of the asset is something which is happening by converting the illiquid asset into marketable security to investor. And further, ABS issuers can be wildly creative. You can't imagine. If I take an example, asset-backed securities have been built based on cash flows from movie revenues, royalty payments, aircraft landing slots, toll roads, etc. Just about any cash producing vehicle or situation can be securitized into an ABS. People say it is wild. Actually, it all depends on the issuer, how wild they can think, how creative they can be. It means it's not only the bank's loan, the revenue from movies, even that can be backing for ABS. ABS can be issued against the movie revenue. ABS can be issued against the royalty payment. We get royalty, for example, if against books which are selling very high, or copyrights which are used by companies to produce products, the royalty payment, aircraft landing slots even, because slots have charges, right. So even they can be used at ABS, which generally they are not very commonly seen in India, but in overseas countries ABS is very active. The market of ABS is very active. People have very good sense, and these all are possible avenues which are actually cash producing vehicles. We call them as cash producing vehicles. They can be securitized. Anything can be securitized basically. We have to create a security. So, ABS is asset based security. So, these revenues, be it aircraft landing slots revenue or revenue from movie or any such thing, can be used as a asset to back ABS. Then further about the working of asset ABS, pooling is there. To release capital and administer risk, the originator sells a pool of these loans to a third party, right. So, X bank, X institution, they are issuer, for example, they pooled it together, right, and then they sell these loans to a third party, typically as special purpose vehicle, as SPV, right. So, these loans which are pooled together 10,000 borrowers are there on the balance sheet of the bank. They pull together, a security has been created, and then they are sold as a special purpose vehicle. So, an SPV is a separate legal entity other than the issuer. So, there was an issuer, now there is a SPV I am talking about. So, the SPV is a separate legal entity designed to be a bankruptcy remote. So, there is a meaning in its assets are protected from the originator's bankruptcy, right. So, they are saved from originator's bankruptcy. If the originator is it turns bankrupt, right, the bank who issued the ABS, if they turn bankrupt, this SPV, which is a separate entity, they would be saving, they become as a safeguard, right. So, they have a role to play. Then issuance and payments, how does they happen? The SPV issuer the ABS to investors, who in turn receive periodic principal and interest payment from the cash flow generated by the original borrowers. A servicer, they collects the payment from the borrowers and distributes the funds to ABS investor. So, are you getting that what is happening? So, first there was an issuer, right, issuer pooled the loans together, for example loans or anything else together, created a security, then it sold to a separate legal entity which was a special purpose vehicle. Second, and then the SPV, they are going to issue this ABS to investors, further investors, who in turns will be receiving the periodic principal and interest. And then there comes a servicer who collects the payments from the borrowers and distributes the funds to ABS investors, because investors were the ones who actually bought this instrument. So, even they are looking for some revenue, right, they have invested, they have taken such a risk because they are looking for income, in fact high income, as I said, right. So, this servicer, another party, another entity, another player in this complex working, they are the people who will collect and then pay they will collect from the borrower the original. For example, if I have taken a house loan, I am paying interest. So, this servicer will collect principal and interest from me and then will distribute it to everyone who, basis on the terms and condition, to issuer, to a special vehicle provider, to the investors in ABS, right. Then there is another concept which is very important regarding the working of ABS, which is known as tranching. The SPV packages the pooled assets and divides them into different investment classes known as tranches. Each tranche has a different risk and return profile. Senior tranches are the safest and they get paid first. Then we have mezzanine and the junior tranches, more risk and yield, as they are the first to absorb losses if borrowers default. So, tranches are SPS packages which the pooled assets, right. So, they divide them into different investment class. So, basically senior tranches 1, 2, 3 like, so senior, mezzanine and junior 1, 2, 3 like that seniority, because less risk means senior one, the more risk means the junior tranche, right. So, these tranches has a different risk and return profile, and senior tranches are safest to invest. So, the last thing I want to talk is that this particular ABS is a very complex asset to be invest in. One has to have a very good understanding about the functioning, about the players, and then should decide about the investment in ABS or not. In future, I would be talking about types of ABS. If you are keen to learn about various types of activity asset backed securities, please do watch our future part number 8. Thank you very much, sir. Thank you.